Investors, the latest inflationary reading is in. Consumer demand is off the charts, and my warning to the love of God for all investors is to proceed cautiously. That's only becoming more pressing. But before I actually get to our economic backdrop and the 7 dividend stocks worth your attention now, I'm Ari, and this channel is all about value and dividend investing. So if that is your investment strategy of choice, you're on the right channel, and if it isn't, you're encouraged to stick around for today's video that will ultimately prepare you for what the Fed Chair Powell is saying will be a bumpy road ahead. Before we dive in, consider helping me in growing this channel by tapping on the thumbs up button, and if you're looking to join me on the journey, there is no cost to subscribe to the channel while you're at it. Now investors, let's dive right in. So before we get to our economic backdrop, a quick update on my personal account. For those of you interested, my account is now sitting at $109,871.16, but I'm really not going to be surprised nor worried if my account loses steam, given all the mayhem that seems to be brewing within the market. You see, last week, the latest consumer price index report was released, depicting inflation notched down nominally to 6.4% from 6.5%. And while progress is progress, the expectations were that inflation would come in at 6.2%, which took the market by surprise. But then following the CPI report, a retail sales report came in, and that was also hotter than expected, whereas retail sales increased by the most in nearly 2 years, up roughly 3% against the expected 1.8% rise, meaning Americans are still spending freely. And that is pretty good for businesses, but cannot last forever and could potentially cause more harm than good come the end of the year if inflation is still sky high. Last but not least, on Thursday, jobless claims came in, and they do so every Thursday, showing that the economy is really holding up even amid Fed rate hikes. Now, what the heck does all of that mean for you and me? Well, because the economy is holding up like it's 1969, literally because we haven't seen this strong of a labor market since then, the Fed is empowered and emboldened to continue jacking up interest rates and could blow right past the terminal projection here of 5%, which will certainly cause pain to businesses and, in my opinion, surely spark layoffs across industries, which is ultimately the goal that the Fed cannot really actually disclose publicly. And in this environment, the market will inevitably be full of fear, because that is pretty human of us all to be in fear as investors during market uncertainty, which is why I'm here to just and let you know that as long as we're investing into companies with strong leadership, great brand names, and well-capitalized balance sheets, you will be just fine, which leads to our first dividend stock on the day today, one that I previously mentioned recently, but I want to double down on given it's both safe as well as profitable. Let's talk General Dynamics, ticker symbol GD, which is a global aerospace and defense company operating as the 5th largest defense contractor in the entire world by arms sales, as well as the 5th largest in the United States by total sales. Now, when it comes to investing into defense contractors like General Dynamics, you're talking about companies that wheel and deal with reliable clients, aka governments, meaning hefty contract deals that often span over a long period of time, all making for beautiful reliability. For example, General Dynamics just closed a deal with the US Navy for ship repair, maintenance, and modernization. Will ultimately receive over $43 million. That is just one of many deals secured for 2023. So this $63.8 billion market capitalized defense contractor certainly is looking better and better as it continues to actually slide on the year, with a current share price of just $232 per share, which is down nearly 6% from months ago. As for their PE ratio, it is just below 20 at 19, which has certainly given way for smart money to begin investing more into General Dynamics, along with optimism from analysts with over 17% worth of upside expected, as the share price is projected to hit $272.50 per share. However, as dividend investors, we can collect on their above sector average dividend yield, as it's coming in at 2.16%. Next up, there is nothing like having insurance just in case life hands us lemons, which it inevitably from time to time does, and Chubb, ticker symbol CB, is there to help us make lemonade as a global provider of insurance products that cover a wide array of casualty from accident to property as well as health and life insurance. So when this $88.38 billion market capitalized insurer begins to slide, it is time we add it to our watch list, given insurance companies have reliable business models that provide plenty of safety. As of this video, Chubb is already down a little under 4% on the year, trading for around $212 per share, and with a PE ratio at just 17, as well as analysts foreseeing over 14% worth of upside, with a share price climbing back up to $244.33 per share, and even smart money padding up their portfolios with Chubb. The positive indicators just continue to present themselves. Now, as dividend investors, we have another above sector average dividend to enjoy, with Chubb's dividend yield coming in at 2.27%. Now, as if our first two mentions were not safe bets delivering consistent profitability through good times and the more volatile times, let's talk about Procter & Gamble, ticker symbol PG, which has been sliding on the year, down by over 7%, trading for just $138 per share, and may continue to slide if investors are fooled by these relief rallies, which only creates opportunities for dividend investors. This consumer goods fortress, which manufactures anything from diapers to detergents, as well as shaving cream, shampoos, and just a plethora of cleaning supply, all of which are necessary even during recessions, making this $327.83 billion market capitalized consumer goods giant an ideal investment, in my opinion. But the safety is going to come in with a bit of a premium, with their PE ratio hovering around 24.5. However, we should never let a safety premium stop us, as we see it never stop smart money from padding up their portfolios. Now, ultimately, we will still see upside that's expected from analysts at about 16% worth of it, with the share price predicted to come back up to $161.63 per share. And until then, as we ebb and flow our way through 2023, Procter & Gamble will be delivering through on their dividend with their 2.61% dividend yield. As for our fourth dividend stock that I am always eager to hype up, let's discuss Johnson & Johnson, ticker symbol J&J. That is, in my opinion, the dividend king of all kings, as a formidable healthcare industry leader with two segments that just continue to be unmatched, whether it's their pharmaceuticals or medical devices. Since their founding over 135 years ago, this now $416.67 billion market capitalized healthcare investment cannot be ignored as a dividend investor, especially when it nosedives by over 10% to a share price under $160, which we are now seeing. And while there's also a little bit of a premium for Johnson & Johnson with a PE ratio at 24, I'm also here to say it is Johnson & Johnson that we're talking about, and smart money is only here with me as I personally dollar cost average into J&J to scale up my position to over 100 shares. Hedge funds are loading up on this opportunity as well. As for analysts, we see plenty of optimism with the share price coming up to $184.57 per share, which is nearly 16% worth of upside. Now, of course, this is the dividend king only expected to continue to shell out their dividend, with that above sector average dividend yield at 2.73%. Moving right along, I want to jump into the utility sector with Consolidated Electric, ticker symbol ED, better known as Con Ed to all of us New Yorkers. Now, why Con Ed? Well, it's a $32.35 billion market capitalized utility company that is one of the largest investor-owned energy companies in the United States, with over $62 billion in assets and providing over 3.3 million customers with electric, in addition to 1.1 million with gas services, all within the world's Big Apple, New York City. Yet right now, Con Ed has slid to just $91 per share, and its PE ratio is also below 20, sitting at just 19.1, which has sparked hedge fund attention, with one of the most well-known investors, Ray Dalio, pouring millions into the company. Now, unless New Yorkers decide to power off the city and not pay their bills, shareholders will just continue to enjoy Con Ed's dividend, also above the sector average, coming in at 3.4%. Next up, dividend stock number 6, a stock that I have been and remain insanely excited about given its correlation to the NASDAQ. Let's talk about T. Rowe Price, ticker symbol TROW. It's a global investment management firm with a vast majority of its assets tied up in the NASDAQ. So as the tech sector avalanched, so too did T. Rowe Price's share price. But as the market turns around, we already see T. Rowe Price's share price coming back up, but it's still down over 13% on the year, trading for only $122 per share, with a PE ratio back under 20 at 18.1. And once again, we see smart money, inclusive of Ray Dalio, betting big on T. Rowe Price. But what I love most about this $27.37 billion market capitalized financial leader is a shareholder's ability to collect on a ridiculously strong dividend yield coming in at 3.96%. And finally, we have Amcor, ticker symbol AMCR, which is a global packaging company that develops and produces all the flexible packaging containers and cartons that you handle throughout your day, operating across industry verticals. Whether it's food, beverages, pharmaceuticals, medical devices, or personal care products, Amcor plays a pretty essential role in it all. Now, it may not be the sexiest company to invest into, but we want profitability and reliability. Well, at least I do. So when this $17.1 billion market capitalized packager falls to just $11.51 per share, and I foresee a rather nil future for the market, I am certainly giving Amcor a look, especially with a PE ratio at just 15.9. And despite all the consumer demand worries, Amcor will remain untouchable, as shareholders will be able to reap the benefits of a solid dividend that is way above the sector average here, coming in at 4.21%. Now, investors, there you have it. From General Dynamics to Chubb and Procter & Gamble, Johnson & Johnson, Con Ed, T. Rowe Price, and Amcor, the 7 dividend stocks worth an add to your watch list as we keep our economic conditions in mind with value, profitability, and reliable passive income desired in 2023. As always, I encourage you all to perform your own due diligence on any and all of these investment opportunities before making any finalized investment decisions. But I'm also curious to catch your thoughts on each of these stocks, so let me know by commenting down below, and be sure to help me out by tapping on that thumbs up button while also tapping on that subscribe button to help us both out in keeping up to speed with all my latest weekly stock ideas. Now, until the next video, I will see you all there.